Joining me on Startup Report is Dr. Richard Smith. Welcome, sir.
Great to be here, Joe. Thanks for having me.
Normally, I would announce your name and the company that you're with, but right now you are just coming out of an exit, so you're not with a company. So congratulations on that. We'll certainly dig into that.
Thank you.
So let's start just with the, familiarizing yourself. There's a couple really interesting, familiarizing our audience with you. There's a couple interesting elements which I think are going to be really cool for the folks who watch Startup Report. And that is you started a fintech company really, really early on. B, exited it, which is fantastic. And C, you did it all from Brooksville, kind of under the radar, which is really cool. So, walk us through the brief, who you are and how you ended up starting that company.
Sure. Well, kind of all starts with my own experience as an individual investor. Back in the late 90s, like 1999, the stock market was going through the dot-com boom, and I was working on my PhD in the mathematics of uncertainty, right? So you'd think that a guy working on his PhD in the mathematics of uncertainty would have an edge in the markets, but I went through the same experience in the dot-com boom and bust as everybody else did, and it was like a real wake-up call for me of, hey, what is this world of investing? How does it work? It obviously, I ran up my life savings, which thankfully didn't amount to that much at the time, being a graduate student and all, to about a 300% gain in like 12 months, and thought I was really smart. And then March 2000 hit, and bear markets work a lot quicker than bull markets. And so all those gains evaporated in about a tenth of the time that they had taken to accumulate. And it really set me on kind of a lifelong fascination with wanting to understand investing and how the markets work. And also a bit of frustration, which kind of the facade that I think a lot of the market presents of, hey, come on in, this is a legitimate enterprise, it's a level playing field, when really there's, a lot to learn and a lot of, I think, unfortunately, a lot of encouragement to come on in and do something which you're not really equipped to do. Nobody would sit down at the piano and expect to be, a competent piano player without at least a year of education, but yet we're sort of all invited to come put our money into the markets and succeed. And, there's a lot of smart people with a lot more resources than you and I have that are out there competing with you. So I really, my background family-wise, my mom was a nurse, my dad was a teacher, and I just really got interested in the markets and how to help learn about them myself and help other people learn about them. And in 2005, I started a website called TradeStops, STOPS.com. And it was a trailing stop loss alert service. Okay, so buy a stock at $100 and say you want to sell it if it falls 25%. Okay, 25% stop loss. You'd sell it if it hit $75. But if it goes up to $200 without falling 25%, now your stop loss has moved up behind your highest point of profit, and you get out at $150 if it falls from there. This wasn't really available that widely in 2005. It's become a lot more available since. But we were really able to bring it to the public, I think, in a way that not only helped them actually execute on the strategy using technology, but really understand why the strategy was valuable and why it worked. It was great.
When you articulate the value of the stop loss, how much of it is, simple awareness of volatility and mechanics? Mm-hmm. How much of it is, I'm assuming the most of it is psychology. How do you sort of articulate the value of stop loss across the different areas that it helps in?
I'm glad you asked, because there's been 2 Nobel Prizes in economics awarded for the simple observation that we hate to lose. Okay, so Daniel Kahneman, I think around 2002, he wrote Thinking Fast and Slow, which is a wonderful book, popularization of his ideas. Michael Lewis, popular author of Moneyball and Liar's Poker and The Blind Side. He's written a lot about Kahneman and Tversky, his original partner. In fact, his most recent book, or one of his more recent books, it was called The Undoing Project. And it was about Kahneman and Tversky and their work on behavioral finance, the psychology of investing money when you don't know what the outcome's going to be, right? And so the other one was Richard Thaler, who wrote more recently, 2017 or 19, and then he wrote Misbehaving. And he's at MIT, pretty big guy. And they both pointed out that we hate to lose, and they got Nobel Prizes for it, right? The trouble is that the fact that we hate to lose has different implications for when we're losing on an investment versus when we're winning on an investment. This is where the psychology comes in. When we're losing on an investment, the fact that we hate to lose makes us want to not sell, right? Because we don't want to take the loss. So, and we'll even double down and triple down. And, one of my favorite stories from one of my customers on a stock that had, gone down 99% from where he bought it was, you know what? I'm going to give that one to my grandkids. It was the ultimate denial of wanting to just take the loss, right? So that's what happens when we're losing. And so when we're losing, we become risk seeking. We want to take on more risk to avoid the loss, right? Then when we're winning, our fear of loss attaches to our profits. And so we become afraid of losing the profits. We don't want to lose the profits, which makes us risk averse. The markets amplify risk. The markets have momentum. Stocks that are going down tend to keep going down. Stocks that are going up tend to keep going up, right? So you have this behavioral bias that puts us in a position of experiencing disaster on the downside, but limits our ability to really capitalize on similarly crazy moves to the upside. So the way this is said in the markets is, you got to sell your losers and let your winners run, But I was able to really explain it to people in a way that they could get it and go, oh my God, that's right. That's me. I need something that addresses that and changes that outcome for me.
When you dig into why people, you hear the stats that it's like twice as painful to lose $10 as it is pleasurable to gain $10.
Yes, exactly. That's it.
And when you break down that pain as it relates to the market, is it because it represents, obviously things change, information changes, and people had the best available information to make that choice at the time. Yeah. When they don't want to make that pivot on that, is it because they're unwilling to accept new information? Is it because it represents a failure of their original thinking? Is it tied into more of just a non-specific general embarrassment? Is it just actual, is it just a straight pain that's not really attached to anything? How do you sort of divide up why that pain exists?
Yeah, I think it's because we attach our egos to the outcome, right? Mm-hmm. And so when you think about it, it's kind of silly to do that. Right? Like, think about how many variables there are that are going to determine whether a company's stock price appreciates or not, right? Mm-hmm. I mean, as individual investors, we're not on the board, right? We're not Warren Buffett. Mm-hmm. We're not even, that privy to, the elite hedge funds of the world and how they manage things and make decisions and have risk management, et cetera, right? So, it's kind of silly to get feelings about ourselves based on whether the price of a stock goes up or down, right? Mm-hmm. And yet that's what we do because we're human, That's what we do as human beings. We want to be able to, brag. We want to be able to tell our friends. And it's just something that you have to learn is misplaced when it comes to investing.
And kind of going back to your original point about marketing to individual investors, you wonder, the way, the action, the prowess, you wonder if they're not set up to make that failure hurt even more because of the things that marketers use to entice them into the game in the first place.
I think the way that most people get brought into the investing arena is exactly the wrong basis from which to be a successful investor. And you are brought in on the excitement of it and kind of the fear of missing out, right?
Mm-hmm.
And you will lose your money in the markets if that's kind of your posture in the markets. Just going back for a minute to why trailing stops work, right? It's because they make you risk averse when you're losing and risk seeking when you're winning. Okay. So Kahneman and Tversky, you talked about why is it twice as more painful to lose $10 than it is to make $10, right?
Mm-hmm.
That's called a utility function.
Mm-hmm.
And you have a certain utility of those dollars to you. And for most people, this utility function is really kind of an emotional feeling. It's really a feeling, right? I failed or I succeeded. As sad as that sounds, that's kind of the approach that even us PhDs, still wrestle with. And when you get into the market uneducated, in fact, the higher your IQ, the more at risk you are of losing all your money. Because you're really good at making up stories about why you made essentially emotional decisions. So, anyways, it's, that utility function. First, it sort of starts out really sloped to the negative, right? When you're a novice, and then it tapers off for your profits. Eventually, you figure out, well, you can kind of even out your profits and your losses, but eventually you have to really have a way of having what I call irrational profits. Profits that defy your expectations, and instead of losses that defy your expectations, right? Mm-hmm. And that's when you really get a winning system. And there's lots of different ways to do that. But that's kind of the emotional posture that you have to get in. And it's not easy. It's not easy to buy stocks 2 months ago when nobody knew what the coronavirus, if it was going to kill 2 million people or 100,000 people, right? So it's never easy. It doesn't actually get easy. You just kind of get the experience of, hey, this is what works, and you need to have confidence in order to be able to make tough decisions at challenging times.
So how do you bring that, for TradeStops to be as successful as it was? Yeah. Obviously, there's just a straight logistical utility in saying alerts, but everything you've talked about thus far, not everything, but most of what you talked about thus far has been the psychology. So how do you push out that value and that mind change through this platform?
It requires a lot of content and a lot of education, and a lot of connecting with audiences, either through public speaking or the written word or doing exactly what you and I are doing, right? So, the simple trailing stop will limit your downside and unlimit your upside. And once you explain to people 2 Nobel Prizes have been awarded for observing that we hate to lose, and then they can connect that to their own experience, that's the start of them going, wow, I should really, give this a try. Right. And, and I think that the business was partly successful because I was able to connect with the audience and relate to them and share my own personal experience with them, and and my mistakes, right, and having to learn and kind of acknowledging that this is not easy to do, and even as you get more experienced and more competent, it's not easy to do. But the other part of it is really building compelling technology that can meet people where they are, and that they can really use. So much of financial technology today is so complicated. Mm-hmm. If you're an investor and you go to the Thinkorswim platform at TD Ameritrade, which I use myself, it's not bad, mm-hmm. but it's way too much for the average person to make any sense of. So how can financial technology really start to take on the role, almost that a financial planner or a financial advisor might do. And technology has really reached that level of maturity that it can do that. You know, it can algorithmically help people, develop a systematic way of investing, and because it's much more integrated into our lives, it can help us um, make the right decision at the right time with the right information. You know, so that's why I'm hopeful that there is a big opportunity for technology to really especially financial technology, to really do something qualitatively different. I think a lot of the financial technology out there has really just been kind of bringing, Las Vegas into your office. And while I think it has been very empowering, I think in the end, it hasn't done enough to really help people hold their own and succeed in the markets and really participate in the markets in an individual way. That's also a big concern of mine.
When you talk about the insiders, the people who have a team of quants and can sit down and crack code everything in the world.
Jim Simons, he's got an army at Renaissance Capital. It's wild. They make 35% a year over like 25 years or something. It's nuts.
Is the mindset that you have to find, are there layers of investing slower, potentially, not as time focused, that individual investor can, places they can play that aren't directly competing with the big intelligence houses?
Great question. I can tell you've spent a little bit of time thinking about these topics already yourself to be able to even ask these questions. So I am a big believer that there is a space for the individual investor in the markets, and it can be even at a day trading space, right? But you really have to commit your life to that practically, it's really intense. For most people, I think that what's possible is that you can build your own portfolio of individual equities in the 15 to 25 stocks range, okay? Probably on the smaller cap side, because a lot of big institutions can't really maneuver as well in the smaller cap space, and it's a stronger growth space. And that you can use simple risk management. That's my background. After I got my PhD, they jokingly called me a doctor of uncertainty. But it's actually a title that I've really come to embrace, because I do think that the ability to even do simple risk management is a very, very empowering activity for most people who don't do it at all. Going back to one of your earlier questions about why do we act this way, it's because we sort of tend to think in black and white, and get attached to we failed or we succeeded. And that's not how it is at all. There's a whole fuzzy logic in there. There's a whole realm of variables and complexities and nuances that once you kind of accept that and you start to work with it, you really get better outcomes, So that's kind of where I'm headed.
So if you were advising then a person ready to get into the market, is it safe to say that you would say start with mindset, start with understanding your temperament, understanding how you feel about risk, understanding the things these Nobel Prize winners have put forth, understanding the environment and even the arena you want to compete in, and then sort of down the line from that, work on the actual stocks and data itself?
Yes. And I think it's fine to put a little bit of money in the market, but you shouldn't put in anything more than you're willing to lose completely. And but it is good to have a little bit of activity and a little bit of direct experience, so that it's not all theoretical, but work your way in, right? I like to use the analogy of flying. right? You want to fly a plane. It's wonderful to fly a plane. It's thrilling. I mean, to be at the controls and be able to take that plane off the runway and fly it up in the air. It's exhilarating. It's a sense of mastery. But nobody would walk up to a plane and go, "Let me sit down in the cockpit and just show me where the gas pedal is." That would be insane, right? So,
especially when you have other people trying to shoot you down while you're up there.
Exactly. So you need to give yourself a little time. I'm working on new technology that I believe will make it more fun and engaging for people to kind of go through that simulation experience, right? And kind of get a little training and a little coaching, and ultimately be able to file a flight plan and say, okay, I'm here at point A. I want to go to point B. Here's my flight plan to get there. Here's the parameters of of my travel, that I can kind of maneuver within, right? That's kind of the risk management piece. And I'm going to execute on that. And we're going to use technology to, maybe even gamify it a little bit, let's say, to help people go on that journey, still find it fun and engaging, but yet actually arrive at their destination. One of my good friends is one of the top training pilots for British Airways. And he often gets up and, he's also an investor. And he says, he talks to a group of pilots and he says, every one of you sitting here has had as many landings as you've had takeoffs. But you can't say the same thing about the investing world.
That's right.
And so I really think it's an education process. I think that technology has reached a point of maturity where some new experiences, technology-based experiences, are possible that can take kind of the psychological and, quantitative knowledge that we have, and create new pathways for people like you and me to successfully compete in the markets. And I didn't quite finish my earlier thought, which was, I think that, stock portfolio of 15 to 25 stocks where your average holding period is 12 to 18 months. Okay. I think that's at least a minimum average holding period of 12 to 18 months. Okay. That's really important, right? So that's where you kind of start to get into a space where the individual investor really can effectively participate without having it to be their full-time job. Okay.
Interesting.
So, and if you can kind of skew towards the small caps, I think you have an even better opportunity. And I really believe that individual investors can even outperform the markets if they will accept, a little more disciplined approach, a little less excitement, but still let's make it fun. Ultimately, let's go after some real positive emotions of mastery and success and, legacy for your family, right? Instead of just like, hey man, I bought Apple 2 days ago and sold it, for a 20% gain yesterday, right? That's not going to make our markets successful. We need more people, more diversity in the markets. They've become so, all the ETFs and the index funds, everything's become so professionalized and so quantified. And I think it's in danger of falling apart.
I mean, that was another question I had with, I feel like ETFs, index funds, just sort of just cake up the middle of the market. And
that's awful.
But then I wonder around the fringes of that, the stocks that don't participate in those, does that then increase their volatility because you have to squeeze all the action into those? And do we see the professional traders playing this, the back and forth in the fringe shares as well? What's your take on how ETFs have affected the market?
Well, I just am concerned about so much of the capital being invested in so few assets, right? And controlled by so many institutions and really successful investors. So I think that's a recipe for brittleness and not a recipe for what Nassim Taleb calls kind of the anti-fragile state, and so it's a concern, and I think that you also, you lose the opportunity to really outperform the markets if you're following the herd and you're doing the same thing as everybody else. So I think there are opportunities on the margins that if you're willing to look out, at least 12 to 18 months for your target holding period, and you're willing to do a little bit of homework, and then, supported by technology and algorithms, that you can build your own portfolio that will, be a little bit more on the stock picking side. Somebody who's in the Tampa St. Pete area there, Jeff Vinnick, he's come out lately and talked about what he sees as it's becoming a stock picker's market, And I think that the pendulum has swung too far to the index fund and ETF. And believe me, I have tremendous respect for what Vanguard, did for the world in creating index funds. And I think it really was a genuine advancement for individual investors. But I think there's now an opportunity, not for everyone, but for people who are willing to put a little bit of time and energy into it, who want to do it, And there's people out there that do want to do it. It's not as hard as you think. It can be supported by technology. You have to have a little more patience than the average bear, and you have to be willing to kind of not get caught up in the short-term noise. You talked about volatility. I would call kind of my specialty what I call volatility budgeting. Okay. So I talked about trailing stops as being the first thing I did, but then I went to volatility-based trailing stops, and I created some proprietary algorithms that used volatility to essentially say, what's the best place to put my stop if I want to hold on to this stock for the next 12 to 18 months, right? And how much noise do I have to endure in the markets to be invested in this stock for 12 to 18 months to not get stopped out just because of the noise? So that's volatility budgeting, right? And then you can use that to decide how much to invest as well, so that you're taking equal risk on your different investments, right? So a stock that has a 10% annual volatility, let's just say, if you're willing to risk $1,000 on that stock, you can invest $10,000, and the noise in that stock may bring that position down by 10% or $1,000, okay, over the course of 12 months. But if a stock has 50% annual volatility, and you're willing to risk $1,000 on that stock, you can only invest $2,000. And if that $2,000 position falls 50%, you're down $1,000. Mm-hmm. So you've taken equal risk, or in the hedge fund world, they call this risk parity. Mm-hmm. But really, it's so powerful because, again, especially novice investors, we're emotional. We tend to put more money into the stocks that we're most excited about. Those tend to be the story stocks, and they tend to be the more volatile stocks, right? So this helps you to kind of allocate more towards the less volatile, more meat and potatoes portion of your portfolio, but still spice it up with some salt and pepper and hot sauce from, some of the more volatile stocks. And those can really work together very well. You can really improve your returns if you are willing to put some hot sauce in your portfolio.
With that analogy, you got to say you can really make a nice meal, right?
Absolutely. You can absolutely make a nice meal. And this is all relatively simple stuff, believe it or not. This is not rocket science. This is some simple probabilities, some correlation, right? And some measuring of volatility, right? And so that's kind of what I've been working on over the last 15 years.
As this is Startup Report, we will celebrate that you recently exited.
Thank you.
TradeStops. Congratulations on that after almost a 15-year run with it, and up to 30,000 customers, or people that use the platform. So that's that's a wonderful fintech grow and exit story right here in the area that I don't think enough people know about. So great, that's great.
Thank you.
And where does that leave you? Where does that leave you looking forward?
Well, I really, my exit was driven in part by where can I create the most value? And so I really want to go deeper into financial technology. In the business that I was in before, I was building financial technology, but it was also connected to the financial publishing space. And I was really kind of solving problems for the people who were buying financial research, had too much research to kind of make sense of. And I helped them kind of take that research and apply my algorithms and turn it into a more systematic approach to leveraging that research and turning it into a long-term successful strategy. So mission accomplished. I created that solution and 30,000 people valued it and used it. And that was incredibly gratifying. And I'm grateful to my partners in the publishing space that helped me build that. Now it's pure financial technology. I really want to build something from the ground up that is new, that's scalable, that has a tremendous reach and possibly can one day even go public. So I hope the next time we're talking about an exit, it's an even bigger story.
IPO. Wonderful. Dr. Richard Smith, thank you so much for your time and congrats again on the exit. And we'll look forward to
I really enjoyed the conversation.
Me too.